Q1FY25 results conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bhavania from ICICI Securities. Thank you, and over to you, sir.
Hi, good evening, everyone. It's our pleasure at ISEC to host Q1FY25 results conference call for Bajaj Consumer Care. From the management, we have today Mr. Jaideep Nandi, Managing Director, Mr. Dilip Kumar Maloo, Chief Financial Officer, and Mr. Vishal D'Souza, AVP Finance. I'll now hand over the call to Jaideep sir for his opening remarks and post the Q&A for the Q&A. Over to you, sir. Thank you.
Thank you, Karan. Good evening, everyone, and thank you all for participating in this Q1 FY25 earnings call. So let me take you through the performance of the company for the quarter ended 30th June 2024 before we open the house of questions. In the first quarter of the current financial year, standalone sales for the company stood at 236.9 crores, and on a sequential basis, the value growth was 3% and volume growth was 2.7%, while on a year-on-year basis, the value and volume saw a decline of 8.8 and 6.7% respectively, due to high base of Q1 last year, as well as a one-time market hygiene correction that we had taken up in wholesale, which I'll explain later. The top line for 4-year CAGR for Q1 is 5.5%, while the 3-year CAGR is 4%. The gross margin for Q1 FY25 on a standalone basis stood at 55.2%, an expansion of more than 50 basis points, both on a sequential as well as on a year-on-year basis. The Q1 FY25 EBITDA stood at 38.4 crores with EBITDA margin at 16.2% of sales, while PAT stood at 38 crores. The PAT margin was 16% of sales for the current quarter. In Q1 of the current fiscal, we implemented a planned one-time correction in wholesale channel in general trade. The discounts were rationalized to reduce over-dependence on top-end wholesalers during the quarter. This resulted in reduced buying from the top end of the wholesalers, thereby depleting their stock holding in the quarter. Hence, while there was a temporary sales impact, the hygiene in the market has drastically improved and stabilized rates in wholesale across the country. This correction has also led to broad basing of our wholesalers by more than 800 numbers, which translates to about 13% of the wholesale base. As a result, we expect the wholesale channel to perform well going forward now that the hygiene has got corrected. Overall, if you look at it in Q1, on the other side, the retail and rural remain steady. Retail loyalty programs, which we had started about a year back for the top retailers in urban, continue to do well, and now we have reached about 12,000 outlets in Q1. This initiative, along with increase in retail outlets, will remain a focus area for the company in the coming period, as it has been for the last 2 years. The company has undertaken an RTM revamp plan, Project Arohan, with a leading strategy consultant. This project aims to enhance distribution, particularly high potential towns and villages, while optimizing representation in lower potential towns. The project will help to expand our reach across India as well as improve servicing in high potential outlets, strengthen the distribution through the right channel partners, and effective channel program management. The project is expected to deliver about 1.4x improvement in outlet reach in retail urban with increased feet on the street obviously, and a targeted expansion about 1.1 to 1.2x in high potential villages in rural. The project has already been launched recently and is currently being piloted in 2 of our key states. The project, after a 5-month pilot, will be taken across the country based on the recommendations that we see and the initiatives that we see are working for this organization. The company has also undertaken geotagging and geofencing for all our direct coverage outlets. This initiative includes geotagging of direct stores to enhance sales for efficiency and, more importantly, to optimize cost to sales. All these initiatives are expected to enhance both our execution efficiency and drive sales growth going forward in general trade. The organized trade business continued to deliver a strong performance, registering a growth of 12% year-on-year and 15% quarter-on-quarter. The saliency of organized trade, including canteen and institutions, stood at 26% for the quarter. Modern trade B2C business grew by 9% year-on-year, supported by growth in independent chains across the regions. The B2B business in modern trade grew by 56%, aided by opening of 150 stores under Metro Cash and Carry. E-commerce B2C registered a growth of 27% year-on-year. NPDs continue to scale up well in e-commerce channel led by Almond Drops hair and skin care range as well as 100% pure coconut. Quick commerce channels like Instamart, Zepto and Blinkit grew by 83% in the year, and this is something that will remain a focus area for the company going forward in the next few quarters. The international business registered a growth of 28% quarter-on-quarter, while on a year-on-year basis growth was modest on a high base. Last year Q1 saliency to full year, just for your reference, was close to about 30%, and we expect in Q2 itself the growth to come back very strongly, being on a softer base, and by the end of the year the growth in international would be a good strong double digit. The rest of world exports grew by 43% Y-on-Y as well as 55% Q-on-Q, with key markets such as Malaysia, USA and Canada performing well. Nepal registered a growth of 76% year-on-year, 20% Q-on-Q, driven by outlet expansion and infrastructure improvement. Middle East and Africa continued to perform well, registered 45% growth Q-on-Q. UAE and Lower Gulf is scaling up well, supported by consumer and BTL activations. Key accounts combined with distribution expansion to 100 plus stores in UAE. Business in Qatar and Kuwait has also stabilized with new partners and are showing good traction. In Q1, we completed our transition from national distribution to own distribution, from a national outside distribution to our own distribution in Bangladesh, with completion of distributors across all 64 districts in the country. ADHO consumer promotion was supported by digital print campaigns and BTL visibility. ADHO consumer research was also initiated to develop effective positioning and brand communication for ADHO's ATL and digital campaigns. We will continue to monitor the current situation in Bangladesh, which at this moment remains volatile. For the company though, this will not have any material impact in the near to mid-term, as presently the contribution of Bangladesh to overall consolidated business is only about 1%. ADHO performance during the quarter was affected once again by the planned hygiene correction in general trade. However, sequentially the brand still registered modest growth. The impact was primarily in sachet and to an extent in mid packs, which were affected in the wholesale correction as detailed earlier. The large packs continued to perform well with close to double-digit growth on a 4-year CAGR basis. The expansion of the 190 ml PET bottle, which we had converted from glass to PET, so which is seeing extremely good traction. The 700 ml pack, which has been introduced in general trade, as well as OT specific packs of 650 and 750, all of them are continuing to drive performance. So the main decline that had happened is basically in sachets, where really speaking there is no effective contribution, so wholesale stocks have gone down a bit in the mixed packs, which we expect to recover in the second quarter. During the quarter, digital media initiatives for ADHO to build reach and tap TV dark markets through YouTube and OTT talk shows resulted in average increment reach of 10% with 1.79 crores views and 89% view-through rate. Social media efforts, including deployment of 84 Amazon affiliate influencers, KOL and micro-influencers, coupled with trending content, led to improvement in engagement rate of 2.2%, which surpassed the hair oil benchmark of about 1.7% for organic posts. The Almond Drops hair and skincare range registered a substantial growth of 77% year-on-year and 86% quarter-on-quarter in Q1 FY25, and it is scaling up well. The portfolio saw the launch of its 7th product, Almond Drops Ultra Light Body Lotion for summers in April 2024, with key ingredients aloe vera, almond oil and vitamin E. This product has been listed in all major e-commerce platforms like Amazon, Flipkart, Myntra and independent retailers. The launch was implemented through on-platform and off-platform activities, affiliate influencer programs and self-stretch. Almond Drops shampoo and conditioner witnessed increased offtake supported by meta-targeting on social media, which garnered 1.6 million views, along with FACs and multi-brand in-cap visibility. We have clearly seen that Almond Drops shampoo is showing good traction, being a hair hair care brand from the Almond Drop portfolio. One of the very good tractions that we are getting, and we clearly see a potential for that to be slowly launched in the later half of the year in the general trade channel as well. Almond Drop Serum Sachet was launched in markets of West Bengal and Orissa in general trade with 100% GTM success. Influencer campaign to drive conversions and build awareness was conducted, and promoter-led drives were held at 40 plus modern trade stores. Initial responses are encouraging with good uptake. Positive consumer ratings and reviews ensured good traction of the brand in e-commerce as well. Almond Drop soap saw robust uptakes in modern trade and e-commerce channel with focus on various bundle packs offerings based on retailers. We remain committed on building the brand awareness through search and display. Bajaj 100% pure coconut oil continues to scale up well with strong double-digit growth with consistent gain in market share in traditional Bajaj stronghold states. Market share has also seen improvement in Maharashtra driven by media initiatives and distribution drives. The brand was supported by TV media and campaigns on OTT during the quarter, which led to an SOV of 40% in coconut oil category in Maharashtra. On-ground activities such as deployment of canter vans, engagements with 5,000 plus retailers resulted in significant increase in participation and distribution as well as consumer connect. Digital media initiatives including fully functional social media page for Bajaj 100% pure coconut oil and campaign on Amazon and Criteo resulted in 3 crore views and a CTR of 0.86% with incremental reach of 20%. As the brand is scaling up and gaining acceptance, we have taken 2 price increases in June and July to offset inflation in copra prices. During the quarter, Bajaj Gulab Jal performed well in general trade after its phased launch in Q3 and Q4 of last fiscal. The brand further expanded its presence through the B2B platforms such as Walmart, Nykaa and Big Basket, as well as independent stores across various regions. Presence of the brand is strengthened through product banners and POSMs, and this will also be one of our focus brands going forward. We have made significant progress in our portfolio diversification with the non-ADHO portfolio, as I just mentioned, and now it contributes to 18% of our total contribution in Q1FY25 and is growing by 17% on a year-on-year basis. For the quarter, the A&P spend stood at 37.2 crores, about 16% of sales. We are committed to investing in ADHO as well as our new brands with a strong focus on digital media to effectively cater evolving consumer preferences. As far as raw materials are concerned, in Q1, the price of LLP remained stable compared to the previous quarter, owing to steady crude oil and base oil prices in Asia. On the other hand, the prices of refined mustard oil saw a slight increase driven by higher purchase by NAFED, which is basically the National Agricultural Cooperative Marketing Federation of India. Around the election period, despite a good crop, however, the global edible oil market has largely remained stable, and hence we do not expect much price fluctuations going forward. The company continued its cost saving and efficiency improvement initiatives. Various measures such as optimizing specs, developing alternate vendors, using alternate packing materials led to cost saving of nearly 1.5 crores in the quarter. Additionally, smart manufacturing and automation efforts boosted productivity by 6% in Guwahati and 12% in Ponta compared to Q1 of FY23. Hygiene correction in general trade along with the implementation project Arahan will have a positive effect on our general trade business going forward. With the organized trade and international business continue to scale up as per plans, our strategic objectives of broad basing of channels and geographies are well on track. Our diversification journey continues well with scaling up of products under the Bajaj brands in hair oils and excellent growth and planned expansion in Almond Drop hair and skincare range. With the above initiatives, we are confident of achieving sustainable and consistent top-line growth as we had stated earlier. With this, I end the opening remarks and open the session for questions.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Rishi Kothari from Pi Square Investments. Please go ahead.
Hello. Thank you so much for the opportunity. I have a couple of questions. First goes I recently read your annual report for FY24, and in that it was mentioned that we as a company want to diversify from ADHO brand to non-ADHO thing. So, and the portfolio we are expansion, we are looking at 30-40% out of it. So what's the current breakup of ADHO and between ADHO and non-ADHO product split in terms of revenue?
So I covered that in my opening remarks. The number was about 4 years back, about 5%. ADHO was 95%, 5% was non-ADHO. By the end of last year, full year, the number had gone up to 17%. The number has now moved up to 18%. We're a little higher than 18%. And we are well on track to reach that 40% number that we are talking about in the next 4-5 years.
Okay. And also, 2-3 years down.
Not take on anything that we can grab. We are very, very specific as to where we are looking at. We are actively looking at the strategy team is continuously working on that. We're closely following some targets, and if it fits into our long-term goal, both in terms of this thing, we may or may not, depending on the size of the pie, we may or may not look at leveraging ourselves. But in case we need to leverage, we will leverage if the overall match comes out in our favor.
Okay. And any capex plan that we have for the year FY25? Any number in mind?
Sorry, I didn't get that. Can you come again?
Sorry, any capex plan that we have for FY25?
So as far as capex is concerned, we are not really looking at increasing our manufacturing facility with any significant investment in capacity building. So as and when the brands scale up, some of the brands which are outside here early, as and when they scale up, we might look at facility, but that's a little far away. At this moment, it will still be under third party, controlled by us, but that is third party manufacturing for the other ranges. Hair oils at this stage, we are not looking at capacity in a large way because capacity-wise we are well covered. It is more in terms of investments that are happening in terms of automation, in terms of ESG, and those do not require. The way we are going about it, those don't require significant numbers which will move the balance sheet too much.
Okay, great. I'm done with my questions. I will join the queue. Thank you so much for the response.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Kaushik Poddar from KB Capital Markets Private Limited. Please go ahead.
See, aside from this wholesale correction, what was the volume growth at the retail level? Do you have any data?
So retail level, we are just about positive. So retail level also just about positive and rural. So between retail and rural, just if you look at general trade, they were both tracking positive on the quarter, while on the year, on the Q1Q, it is actually just flat on the Y-on-Y and Q1Q with a marginal growth.
But if that be the case, how can you approach that? Last time, if I remember correctly, in the last analyst con call, you had talked about a double-digit growth. I mean, is there something different that has happened since the time you gave that statement?
No, if you were to just break down our 4-quarter numbers, and you will see that our quarter one last year, and that's why you see our CAGR is still very, very high. 3-year CAGR, 4-year CAGR of Q1, even with this declining sales, is pretty high. Because last year Q1, if you look at, the number was extremely high. After that, it had actually tapered in Q2, Q3, Q4. So if you just crunch those numbers, you will see, when I just bring back the wholesale numbers back, you will see the number to, let's say, a 6-7% growth seems to be pretty doable. We would be targeting a little higher.
6-7%, you're talking of value growth or volume growth?
Value growth. Our numbers are all in value growth. Volume will typically be a little higher because anything that sells beyond the GDHO has a pricing listing of lower than ADHO in terms of per unit. So the volume growth will be higher. But in our case, the volume growth really is not that significant because unless you have a category which is just pure that product, I mean, if it was only ADHO that I am selling, then volume growth does make any relevance. But when I am comparing a portfolio which is completely different, volume growth would not really make sense. I mean, if my coconut were to grow much faster, the volume growth will be much higher. So really speaking, mentioning that will not be able to. So we monitor it more from our value interests.
And how is Q-commerce shares scaling up?
As I said, it had gone up by about 85%, this year 83% to be precise, I think. In fact, that is a clear focus for us. Two reasons. One is obviously we see that even now Flipkart coming into it. So all of them are, clearly getting traction, not only in tier 1 towns but even lower. So our focus in the last 2-3 months has gone far higher, and it will continue to go far stronger into that. While our category is not impulse category, so not so neither food, so it may not have huge numbers, but we want to maximize our presence there and try and get. In terms of our assortment, I think we are pretty well structured in most of Instamart, Zepto, Blinkit, and now Flipkart Minutes comes up even there. So already we have got that. I think we want to scale it up really aggressively there. Clear focus for us is that. The other fact also remains that these are more profitable channels, right, within e-commerce, profitable, let's say, retailers within e-commerce over the larger players. So obviously, our interest will also be to focus strongly on these.
Now, is the margin higher in Q-commerce, you are saying?
Over other e-commerce, over the other larger retailers in e-commerce, yes.
Okay. And my last question: what is the share of your sales from e-commerce? You said.
Our sales of e-commerce in overall, if you look at it, is about 26% from modern trade. E-commerce is about 10%. Modern trade is about 11%, and about 5% comes from CSD, CPC, and all that. So 26.
No, modern retail is 20%. You said, right?
Modern trade is about 11%. 10% is e-commerce, and 5% is CPC, CSD. So all put together, about 26% is what we call the organized trade. And general trade contributes the balance.
Okay. Thank you.
Welcome.
Thank you. The next question is from the line of Nikhil Upadhyay from SIMPL. Please go ahead.
Yeah, hi. Good evening. I hope I am audible.
Yes, you are.
Yeah, sir, just one question. Coming back to this, the inventory readjustment or the readjustment at the GT level, if you can just help me understand a little bit better, because so where I'm coming from is that if I map our GT sales from 22 onwards to 24, we were in the range of 180-190. For last 3 quarters, our reported numbers were in the range of 170. So last 9 months, we were already looking at a drop in sales at the GT level. So on the inventory side, I think the channel was already not performing. So parallelly, there couldn't be having very high inventory at the GT level. So what is this change we have brought in?
No, so overall, if you look at, yes, if you are asking whether GT has remained subdued overall, I think for most companies, GT has remained subdued, as it is for us as well. So GT has remained subdued. On the other side, the correction that has been done is basically in terms of our structuring of how we had our wholesale slabs. We were actually giving a higher schemes to the larger wholesalers. So stocking was happening mostly at the larger wholesalers, where the lower end was falling off. So there were market instability. I mean, that is, as you go to the market, you will see that is there for quite a few companies. I'll obviously not say all companies, but many companies have this issue because it's much easier to sell to the larger wholesalers and get quick sales. So that we wanted to correct over a structural correction, which is what we embarked in May or end of April, May, and then continue with that. Now it is stabilizing. It takes about typically 2-3 months to stabilize that. So the difference that had gone up between the smaller slab wholesalers to the larger wholesalers is about 3.5%, which typically ideally, good ideal condition should be between 1 to 1.5%. You still have to incentivize the larger wholesalers more, but beyond a certain point, then you will have the dynamics itself will change. They will become the distributors rather. So that dynamics has got corrected. Now we have got that difference between the larger wholesalers to the smaller ones. reduce that. And as a result, what has happened, the hoarding that the larger wholesalers were doing, they depleted their stocks and they are now operating. Now, wholesale really doesn't impact consumer offtake. So the consumer offtake is going on. So wholesaler stock has depleted and now they are purchasing as much they want because they are not getting that large advantage, which suits us well because over time that number gets neutralized and they will have to keep servicing whatever is required. We really don't want the wholesalers to hold a lot of stock. So that's where we are.
Okay, and just a continuation, if you can just help me understand, because see, we were looking at this issue on the GT side for almost last full 24. So why didn't we brought this change in the previous year itself? Because the channel was not performing and this dynamics would have been true last year as well. So I'm just trying to understand that, was this in process from almost 6 months and the effect has come out significantly in this quarter, or?
No. So typically what happens is, this you will see is a cyclical phenomena which happens every 3-4 years, gets accentuated typically when the demand conditions are poorer. As I said, this is, if you were to go to the market, you will see quite a few companies have this real wholesale instability in rates. This typically happens when the wholesalers need to offload their stocks and are willing to operate at a much thinner margin, maybe at sometimes at a marginally negative margin, just to ensure that the rotation of inventory, etc. goes on. So this is exactly what has happened. I mean, it's not a planned thing that we wanted to support the larger wholesalers or ensure that they become the meaningful distributors, etc. It's a question of when the market is slower, hoarding of inventory will happen. At some point of time, you'll have to take the correction. So we have taken the correction, I think, when it started about in 2021, and this is so cyclical corrections do keep happening. There are correction, and I am assuming that for the next 3-4 years will not required to do these corrections. And if the market remains buoyant or the market becomes buoyant, anyway these corrections won't happen. So then the rotation of the inventory will be anyway much.
Okay. And see, what we are also hearing, and this is a common theme across FMCG or smaller durable companies, is that the rural growth is recovering. So, and with GT being higher on the GT channel being prominent for us, if we have to understand how are things moving now month on month, like are these post this correction at those large wholesalers, are you seeing volume growth coming from them year on year, or just some sense on?
Yeah, sure. So clearly rural that we had seen earlier, which was really struggling and was a laggard, clearly is turned around. I mean, rural is still performing better even for us as far as between the channels is concerned. The other thing that we have also identified is in terms of rural, there is a clear opportunity for us to expand into villages where there are unrepresentation as far as we are concerned. So while we are well distributed as a company, we just about cover about 66,000 villages. And when we were doing this project, even earlier identified, and now when we are doing this project a little more, let's say, analytically, we are seeing clear opportunity for us to have a 1.1 to 1.2x growth as far as the existing villages are concerned. So we are just mapping our cost to sales as well as the number of expansion that we require to do. Clearly, we see an opportunity for 6,000 to 10,000 villages getting added, and this is obviously at the country level, not at the pilot projects. So this pilot is happening on that, and we are finalizing the model. So one is obviously the markets are improving. We are seeing traction in these markets. The other is our own internal effort that we are going to push as far as rural representation is concerned, as in terms of the number of villages that we want to get. So clearly these two things we feel will aid to our growth back in rural areas.
Okay. And just last question. Last year, one of the parameters which we said, if you look at the health of ADHO as a brand, the larger packs were growing better and the smaller SKUs were not growing, the smaller LUPs. If you have to see the trend sequentially and not from Q4 to Q1, but over the last 4-5 quarters, if we plot the trend and you would have it, are you seeing that changing for the lower LUPs, or are they still degrowing and most of the growth is only coming in the larger SKUs? How is it split between the two?
So good questions, and I will just split it a little. As far as the larger packs are concerned, you are absolutely right. They are growing. That's where mostly the competition. We see like one competitor at an extremely discounted price as far as almond is concerned, going at about 20-30% lower than us. Yes, making some dents in modern trades, etc., but I don't see them making the dent as far as gen trade, which is our core function, which puts us well. One category where the market has actually reduced a bit, which is the sachet pack. In fact, after COVID, there has been decline. We have arrested a bit of it, but that's a natural movement in the marketplace. As far as the smaller packs are concerned, the 10-20 rupee packs, as a company, we have always remained in the 10-20 rupee pack, and 10-20 rupee pack in the last 3-4 years have been gaining salience. I mentioned to you that last time that in the 10 rupee pack, there are interventions that are happening. There are interventions in terms of packing, etc. I don't want to talk of it because the launch will happen sometime in Q3, and when we launch it, we'll exactly say what intervention. One of the interventions is to ensure that in terms of perception to the consumer as well as in terms of quantity, it is able to play with the other 10 rupee pack which are there in the marketplace. Today we are both perception-wise as well as in terms of actual quantity, etc. We are far lower than that of the other cheaper brands and hence getting ruled out. So we are looking at how to maintain so the work that has been happening for the last maybe 7-8 months, or actually a little more than that, to ensure how our gross margins are protected, and yet we are able to do that. So I'll get back to that exact what work we have done, etc. Before the launch, I don't want to talk of it. That should see in Q3, and we can hope that in that LUP packs we will have a good number coming up, because that's the intervention that is happening. In mid packs, we have done some price interventions, because in terms of the price, our prices have gone up. I have already presented that earlier. We have had good, I will not say good fantastic growth or something, but our decline that we were seeing earlier has got arrested, and this is something that we will continue to push forward as far as the business is concerned. So DHO more or less, I think we are well covered on. Yes, we will not react to very, very low prices that are being offered in the marketplace, but I do not see too much of impact that is going to have.
Sure, I'll come back in the queue. Thanks for it.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Prolin Nandu from Edelweiss. Please go ahead.
Yeah, hi, sir. Thank you for giving me this opportunity. A few questions from my end. First is this one-time correction that you have taken in the wholesale channel. Is it fair to assume that from July onwards, things are back to normal in terms of sales momentum, what we have seen in Q4 before this intervention has taken place? And are there any such correction in terms of either product or channel which can, in a way, have a temporary disruption of a quarter or two going forward? And if I were to probably, look at your numbers, your guidance of, high single-digit kind of a growth for entire year, for the remainder of the quarter, 3 quarters, a double-digit value growth is possible. So yeah, that's my first question.
So let me answer that question right away. First and foremost, this was the only correction that was envisaged. There is no other corrections or interventions or any negative adverse any action that will be taken which will impact the market. So this was in our mind not very adverse in terms of adverse in terms of sales numbers, but not adverse in terms of basic market practices. That has got developed and we had to correct it. And as I said, it was not only our company. We have seen this happen for many other companies. We wanted ours to become much more healthier. To your question was, part two was whether we see that correction impacting and whether it is coming beneficial. As I mentioned, we have seen more and more wholesalers, 800 numbers, as I said, I called the numbers straight away out for you. 13% of our wholesale base, extra numbers over Q4 we can see has added back in Q1. That direction is going to continue. The larger wholesalers are still under wait and watch. More than wait and watch, they are now not holding stocks, which is okay for us. So really speaking, numbers will not get too impacted if they do not hold. And we really don't want to hold them up again and go back to the earlier path. So this is where it is. As far as sales growth are concerned, as you rightly pointed out, Q2, Q4, it has to have a strong growth rate. I don't want to get into numbers, but we feel that these corrections that we have done, the project that we have undertaken in GT, the way modern trade and e-commerce is behaving, our focus also stronger on quick com, the way our new products are scaling up. I mean, earlier we would only talk of mainly the coconut, the beta formula, etc. Now we are seeing a whole range of almond drop extensions coming up. We have some plans for some of the other products. Also taking some of these products into general trade. So I think we are very confident that we will be hitting the numbers that we have been talking about today.
Thank you for that elaborate answer, sir. My second question is on margins. Now you are, I mean, if I'm not wrong, over the near term or medium term, you're guiding for a 16 to 18% kind of an EBITDA margin. Now, if I look at the history of Bajaj Corp, right, from FY13 to FY21, on an average, our gross margins were in the range of 66 to 67%. Our EBITDA margin was upward of 24-25%. Are these numbers too hard to look at in the next 3 to 5 years? Does this numbers require some kind of a very drastic correction in raw material, or the competitive intensity in the current market is such that it's very difficult to
So I think you have answered most of the thing in your question itself. Competitive intensity is something that we will have to keep a watch out on. So we see one of the competitors being extremely aggressive. Not all of the competitors, but one of them. So obviously we'll have to be cognizant of that. I mean, they operate at a net margin which is far lower than most of the others. But I think if that is the norm today, we'll have to live with that and play counter to it till corrections happen. Obviously, the other thing is, given that the market has been subdued over time, I think that's how most of these companies are reacting, some of them more like that. So going back to that 23-25% EBITDA margin in the short term seems unlikely, also because at that point of time, we were a very low cost to serve single product company. Mainly single product company. Low cost to serve, I say this because it was more a wholesale driven company with starting of retail contribution, etc. Now that you are looking at retailing as a big activity, which is also required because you would want to push your new product range, etc. I mean, your entire structuring of the company is to make it more diversified, more stronger in terms of not being only in GT, only in wholesale, and only in ADHO. So that in that exercise we have come a lot. At this moment, the investments are happening, so some of the numbers are coming in, but the large numbers, as we see, as quarters go by, we are getting more and more confident of more and more products succeeding. These investments will continue. So we would like that 16 to 18% to continue for some time, where the scale builds up, and then we look at improving the margin. If we look at improving the margin beyond 20 or wherever there, at this moment itself, I think the investment funnel will have to go down, both the product investment as well as in terms of the retailing, etc., all the other investments. That is not something that we want to do. It might look good in the short term, but on the long term, the company gets impacted, and that is not what we would want to do.
Sure, sir. Thank you so much. And last question, Jaideep sir, to you would be, if you joined sometime in July of 2020, you have completed 4 years at the helm of this company. What would be some of your, few hits and misses in your tenure, and what would be your priority, right, for the next 3 to 4 years right? So that's it from my side. Thank you so much for taking my questions.
So let's start with the miss itself. The miss straight away is the top line numbers. I don't think there is any question denying that as a miss, what would be the first miss to point out is clearly the bottom line number, the top line number. Bottom line wise, I'm really not concerned because this is the bottom line you would have to come to anyway if you want to push that. So on the positive side, if you are to talk of the hits, etc., I think as an organization we are far stronger today. Maybe the numbers do not reflect immediately, but yes, in terms of process, system, people, all that is geared for success. We are building the company, we are building brands, we are building channels, we are building the international business. I think all of them are in a build mode, and these are not just theoretical statuses. These are all things which are already starting to bear fruit and show results. So at this moment, I would personally think these are clear positives in terms of people, in terms of process, in terms of automation systems, etc. We are making this far stronger company, a company which can rub shoulders with the good companies in this industry.
Sure, sir. So, and just, I mean, would top line be your number one priority going ahead, since you have highlighted that as one of your misses? Or, if you can just give us some, some more priorities in your next.
Let's take us back in that, as you said. So let me take you back to the last 4 years. At that point of time, it was building this organization. So this process building, etc., etc. I think most of that has already been built. If you ask me today, will building processes, systems, people, etc., will still be a priority? I'll say no. Maintaining it is my priority, but building it is, I will not be sitting. Now it is business as usual as far as those aspects are concerned. Building a portfolio of brands, supporting them, getting them into looking at how we look at innovation, etc. I think that has also come in place, and now it's time that we start reaping in some of these benefits. Have we seen overall top line numbers move really well? The answer is no. But have we seen in specific strategic pillars these top line numbers moving? I say, it's a resounding yes, whether it be new products, international channels, etc., etc. Clearly yes. And I think the work that we are now doing in GT, as we improve that, I think as a company, these top line numbers will also start rolling.
Great, sir. Thank you so much for answering those questions, and all the very best, sir, going ahead.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Harish Shah from Rira Holdings. Please go ahead.
Hi, good afternoon, sir. So we've only recently started tracking Bajaj Consumer, so apologies if I'm being repetitive with any question. So coming back to this channel correction which we did, so in Q4 we had a distributor stock correction to the tune of around 12-13 crore, and then this quarter we have what we call it a hygiene correction at the wholesaler end. So just wanted to understand the difference between these two. I mean, is it a continuous activity that we are doing, or there's something starkly different about both these corrections? And at the same time, so is this correction induced by the channel partners? I mean, were they the one who came to you and complained about having high inventory, or is it something that was initiated from your end?
No, so both are initiated from our end. The two are completely different. Distributor correction is basically the difference between the primary and secondary. Basically, we wanted to ensure that distributor overall stocks go down, so primary billing was okay. This now we are talking about is the distributor, wholesaler, and wholesaler stocking, because the wholesaler stocks have gone up. So finally, distributor is servicing the wholesalers. We wanted to ensure with the wholesalers, and it was not so much of stocking that we wanted to address. I mean, stocking, we knew that stocking will get addressed, but stocking was not the primary purpose. The primary purpose was to ensure the rate stability that has come up in the marketplace with the larger wholesalers who are hogging the marketplace with lower prices than what the smaller wholesalers were buying from the company. That we wanted to correct so that the smaller wholesalers also participate with us, and we have a larger base of wholesalers to operate. Otherwise, we would be getting more and more squeezed by the top wholesalers. And as I speak, you can go to the market and see there are companies where that is, and large companies where that is a issue today, much worse than us. And the correction would require what I just did, and that's a call somebody will have to take. So this exists today, and I do not want to comment about how different companies should operate, but we felt as an organization that this hygiene correction needs to be corrected now, so that going forward, all those RTM that we are wanting to implement across the country, that we are in a situation where this does not bring it down. I mean, we wanted to be in a much cleaner, more hygienically stronger situation where we need time. So this is what is in mind. So this is the wholesaler part of it. That was more correction of primary.
Okay, that makes it much more clear to understand. And second question is on the ad spend. Now, if I look at last 10 years data, we have cumulative spent nearly 1450 crore rupees in ad spend. But at the same time, if we look at the top line growth, it doesn't actually reflect the kind of spend that we have done on advertisement and marketing. So, I mean, any brainstorming on that part as to how we can, increase the efficiency of this spend, because 16-18% is a high number as a percentage of sales, and we have been doing it for almost 10-12 years. Because at some point you expect that this number to taper down because a lot of margin is getting stuck. Because on one side we are not able to improve the gross margin because of the competition, and then on the second side we have this really sticky expense which is taking away a lot of money. So any thought process on how we can improve the efficiency of this spend, and actually how can it contribute to the top line?
It is a construct of the market. It is not so much the efficiency. If you look at this particular brand, which is a premium brand with a higher gross margins, typically the way you measure your advertising spend is basically in terms of how much are you spending compared to, it's always a relative spend, right? So compared to the market, how much are you spending versus what is your share? So we call it a share of voice, which is basically how much you have advertised, versus share of market, which is your market share. So typically for a premium brand like ours, we operate at a 1.4 to 1.5 times SOV to SOM, which means if you have a market share, let's say, about 10%, then you should do about 14 to 15% of the total overall spends as far as the marketing is concerned, because that is what is required to ensure that you can demand that premium pricing that you have with that gross margin of 55% or so that you are commanding. So this is nothing to do with efficiency of the brand. And if the issue that you have is over the last 10 years, as we are talking about, or over the last at least definitely the last 8-9 years, is basically the hair oil category itself has not grown much. So this efficiency that you are talking about would have got translated into numbers if your hair oil category would have, let's say, grown by high single digits, which has not happened, and hence ATH has retained its market share position, but it has not been able to grow much. Unlike now the others have grown either, but this is what it has. So really speaking, it's a construct of the product which requires this kind of investment. Now where we are going to, now why the investments are going up is because you need to advertise, because we have only advertised in ADH and nothing else. So we have built only ADH and nothing else. We need to change that as a company. We need to diversify our portfolio to become a stronger organization, which is the journey that we started 3-4 years back. And now it is starting showing traction, not this quarter, for quarter after quarter. And this is something that we will continue to do. That will require investment because these also become the ADHs of the future.
So going ahead, since we're expecting maybe a high single-digit kind of a growth for the next 3, 4, 5 years, so how do we look at the ad spend? Will it remain same on in absolute basis, or do we plan to keep it same in terms of percentage of sales? Because we're spending close to 165 crores. So will this absolute amount will be maintained, or will we keep on increasing as our revenue also goes up?
Ladies and gentlemen, the lines of the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the lines of the management reconnected. Over to you, sir.
Yeah, thank you. Yeah. So, any further clarification, Harsh?
Yeah, actually, I had one question on the ad spends. I think the line got disconnected. So my question was, going ahead, do we plan to keep the ad spends at 165 crore that we spent in FY24, or do we plan to increase the budget as the top line goes up? I mean, do we plan to keep it at 16 to 18% of sales going ahead as well, or in absolute terms we will keep our budget same?
That is what I answered earlier. If we were to take it even further, more aggressively, I might have increased the ad spend further and and taken up more brands as far as GT is concerned going forward. But we would like to be a little more prudent. We'll operate at the 16 to 18% ad spend and keep introducing, as the business scales up, we'll keep introducing products in GT, one or two large products in GT which we can develop and make it larger. So that is exactly how we are going about. One of the launches will happen in 2-3 of this year, and this is what we will continue. 16 to 18 is what we will keep the number at.
Okay, sure, understood. Thank you so much. That's it from my side.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments.
Thank you so much, and thank you for participating in this call. As you have seen, in the last quarter, we have taken quite a few hygiene corrections because as an organization, having done so many initiatives, both as you can see in trade as well as in terms of new product introductions, modern trade in charge. We wanted to be in a position where we can actually take advantage of all these initiatives and have a strong organization with good, strong, consistent growth going forward. So this one-time correction had to be taken. We took it this quarter. Any quarter we have taken, we would have taken this with it. We have taken this correction, and going forward, we intend to deliver the numbers that we have been talking about based on the strategic pillars that we are taking. So thank you for participating, and best of luck and strong weekend. Good weekend for you. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.